Taxes are so much fun, don't you think? If you've started looking into real estate investing, you've probably heard that there's special tax advantages that real estate investors get to take to be able to offset their taxable income. This is one of the great ways you can make money in multiple ways through real estate investing. Well, it's true. It's complicated, but it's true. Luckily, you can absolutely build wealth faster if you know some basic general concepts about taxes and how they work for real estate investors. I'm Susan Elliott, and in this video, I'm going to talk about 5 simple concepts that you need to know as a real estate investor, especially as a passive real estate investor, so that you can leverage these special tax advantages and reduce your taxable income. On this channel, I like to help regular people invest in real estate without having to sacrifice their time as landlords hustling over the weekends and weeknights, and know that they can build wealth using real estate without sacrificing their time. And you can live a life you want along the way and not in some distant retirement scenario. So if that sounds good to you, subscribe to this channel, like this video, and let's dive in. Taxes for real estate investors all hinge on passive losses and passive gains. But first, I have to tell you that I am not a CPA, I'm not a tax professional, I'm just a real estate investor who loves diving deep into these concepts to be able to help other real estate investors take advantage of the uniqueness, the special things within real estate investing that can help you build your wealth faster. Absolutely, my goal with this video is to equip you with the knowledge to take 2-year CPA so that you're not leaving these kinds of gains, advantages on the table. You're not leaving money on the table at the end of the year. Okay, let's first define passive losses and passive gains. Losses are negative, right? They're from things like bonus depreciation or regular depreciation or cost segregation. These are basically expenses, things that you're spending on the property. Now, it's worthwhile to understand what each of those means, which I'm not going to dive into here, but know that you're not doing any of the calculations on this. As a passive investor, this number just gets reported on your K1 every year. But you can get a general sense for what the passive losses might be on any given investment by looking at your deal offerings and simply asking, hey, are you projecting that there may be any losses in year 1? What percentage of my investment would be losses? These are numbers that you generally have an idea with before you join the investment. Okay, passive gains are simply income that you've received, whether that's from regular distributions, your quarterly or your monthly distributions, or sale proceeds from that asset being sold at the end of the deal. So the passive part in each of these just comes from the idea that you're not materially participating in the active management in a consistent way of this asset. Now, this is all that IRS language around if you are a passive or an active investor. But this is one of the biggest benefits of passive real estate investing. You don't have to be that active investor. You don't have to be the one managing tenants, going over legal contracts with multiple partners, all of that, and you can still take advantage of those passive losses that are coming down the pipeline. Okay, let's dive into the 5 concepts you need to understand passive losses and passive gains as a passive real estate investor. First concept is that passive losses offset passive gains. Now, most passive investors can't take the passive losses they receive from their real estate investments to offset their W-2 income or active income. Passive losses can only offset passive gains. This means that most passive investors who are W-2 employees, like so many of us, can't take your passive losses from your real estate investments and take them against the gains or income you have from your W-2 job or your active income. You have to have passive income to leverage these benefits against each other. There are ways to make that work, something called the real estate professional status. It means you have to spend a certain number of hours per year on your real estate investments to be considered that you're materially participating in them. It's a little bit hard to get to that point, especially as passive investors who love their jobs and want to keep W-2ing it out. But we do have a video that talks more about that if you think that you might qualify for that status. Okay. Concept number 2 is that passive losses can be carried forward into future years to offset those gains. Okay, let's look at an example. Let's say I get $40,000 of losses in year 1 from an investment that I make. Now I also have, I earned $10,000 that year. That means I'm able to offset that earnings with that loss, and that leaves me with a $30,000 loss at the end of that year. Now that's $10,000 that I'm not adding to my taxable income. That's great. But I also now have that $30,000 of losses that's going to carry forward into the next year of that investment, and the next year of that investment, all the way until that property sells that I earned that loss on originally. This ability to carry forward losses is a bit like a snowball effect. You can imagine like every year making a new investment, you're going to build up your losses and hopefully build up your gains, right? That you're offsetting each other every year. Okay, concept number 3, passive losses on one investment can be used against passive gains on another passive investment. So for example, I have $25,000 invested in a multifamily property in Texas. I've been able to use the gains I've gotten, the losses I've gotten from that investment to take against another investment I have, and the gains I've received on that, again, another passive investment that's located somewhere entirely different, a self-storage facility located in Oregon, right? So I'm able to use those losses on different investments as long as that original asset hasn't sold yet. It hasn't expired. Again, that's the 4th concept here, is that these passive losses essentially expire once that property is sold. Okay, so back to that first example where I had $40,000 of losses. I earned $10,000 that first year, so I was left with $30,000 of losses to use against any passive income that I might earn over the next few years. Let's say that that asset is then sold 5 years later, and down the line, I now only have $5,000 of losses. Well, those $5,000 of losses are going to be gone unless I can have $5,000 of passive gains in that same year. So even if that asset sells in February of one year, I have to earn passive gains anytime in that calendar year to be able to use those passive losses that are still on the table. This is really important because this is where you start to get to optimize your tax strategy. You might look for investments that are going to give you more passive gains in that year so you can offset your losses. Okay, the 5th concept here that everybody loves talking about that I can't not mention when talking about taxes in real estate is the 1031 exchange. You saw me roll my eyes a little bit there because it sounds like a really cool thing to do, and I absolutely advise you to look into it. I would say that I'm sure most people make a lot of money this way and are able to move their taxable income down the road, their tax bill, but it doesn't work in every scenario, especially in passive real estate investing where you're moving as a group into different group investments. The 1031 exchange rule allows you to sell one investment property and use the proceeds to purchase another like-kind property and defer capital gains taxes. You get to transfer passive losses from one property to another, which normally you wouldn't be able to do. You get to offset passive income generated by the new property. You get to reduce your overall taxable income, and you get to build your real estate portfolio along the way. All right, those are the 5 strategies. Remember, how can you use this to optimize your tax strategy, your investing strategy as you move forward? Again, it's important to note that your passive losses can't be used against your active income, your W-2 income typically. So this is all playing a game of how much passive losses am I getting and how much passive gains am I getting? The best way to do this is to go to your CPA and ask them. Maybe they've prepared your taxes over a few years and you can say, hey, how much passive losses do I have sitting on the table right now? That's going to be able to help you understand maybe what investments you want to look for in this next calendar year, the next 2 calendar years. You might be alerted that like, hey, you have $10,000 of passive losses that are going to potentially expire this year because this property will likely be sold. You might want to look for investments that are going to give you more passive gains this year. And remember, even if this conversation between you and your CPA helps to inform you that your CPA doesn't know how to talk about any of this stuff, that's really valuable information. You want a real estate professional on your team that can leverage all of these advantages so that you can have a reduced taxable income. You can make all of the money from real estate that real estate has to offer, okay? So even if your CPA doesn't know what to do, that's great information because now you know you need to find a new CPA potentially. And then remember, as you invest more, this becomes increasingly important. You're gonna build up those losses, you're gonna build up those passive gains Early stage investors don't necessarily have enough of either one to really make a big dent here, but it's worth looking at it now so that you can optimize it as you go. All right, if you've enjoyed this video, again, please like it and subscribe to this channel so that I know what kind of content helps people out there and I can create more of it. Comment below if you've ever used any of these strategies or if there's some other one that I'm not even talking about that I haven't even learned about, because again, I'm not a tax professional. I'm just a geek who likes real estate. Please comment below and we'll see you next time. Thanks.